Foreclosures are up 26% year over year. What does that mean for you and all of us here in the Raleigh real estate market? Are we about to experience what we experienced during the Great Recession in 2008, 2009? Well, we are going to dig deep on that data for you today following our normal market update. I've got Nick with me here today, and we are going to get into it right now. Here we go. Hey everyone, I'm Heather.
And I'm Nick with Taylor Realty Group,
where we create real estate experiences tailored to who, Nick?
You!
That's right, tailored to you. Before we get into the headlines, we're going to show you what's actually happening in the market right now because, spoiler alert,
it's pretty boring.
And actually, boring is good news. Nick is joining me for the market update because going forward, Nick's going to be the Tailored Realty Group specialist for Chapel Hill and Carboro.
Which means Taylor Realty Group now covers more of the triangle than ever.
Okay, as always, let's start with the median prices for homes that closed in May of 2026. As always, we do this separated out by town and by type of home. As you can see, we've added Chapel Hill and Carboro to this list, so you can check those out. And now we will move on to the data that actually shapes your buying and selling strategies. Every month, I show you the green and red arrows representing the direction the market is trending. The red arrows mean the market is slowing or trending more in the direction of a buyer's market, and the green arrows mean the market is speeding up or trending more towards a seller's market. But honestly, both month over month and year over year, the changes in the data this month are so minor. While I'll still include the arrows for a visual representation of how things are looking, just know, overall, the market is basically flat. Let's start with the months of supply, which indicates how long it would take to sell every home on the market right now at the current pace.
So under 4 months of supply is a seller's market. Above 6 months is a buyer's market. Everything in between is balanced.
That's right. And currently, all of the towns are below 4 months of supply. And Holly Springs and Cary have actually dipped below 2 months of supply. Compared to a year ago, the numbers are slightly better for most towns, although pretty similar to what they were last year. And the same is true when we compare month over month data. When it comes to price reductions, it's a similar story. Currently, we're seeing Cary and Apex right around where they were last year, although Apex has seen a noticeable improvement since last month. We're seeing some up and down fluctuations in Holly Springs, about the same percentage of price reductions as last month, but about 10% more price reductions than we saw this time last year. Morrisville is a real dog, as we'll talk a little bit more about, with price reductions on over 43% of their listings. And although that's higher than last month, it's actually better than last year.
With these numbers bouncing around each month, I'd say the takeaway for sellers is to price your house according to data, be aggressive, and prepare your house properly so you can be one of those happy sellers who sees multiple offers and closings over list price. Speaking of list price, Heather, what percentage of original list price are sellers actually getting?
I'm so glad you asked. For closings last month, Morrisville sellers, guess what? They had the worst outcome of the bunch, with homes averaging 96.3% of the original list price, while Cary sellers got 98.7%, Apex 98.5%, Holly Springs 98.2%, and Fuquay-Varina 97.8%.
With the exception of minor fluctuations, these numbers are pretty similar to both last month and last year.
Yep, and we're seeing a similar number of homes selling over list price as we did both last year and last month, with some minor fluctuations. Morrisville, no shock, remains the town with the least number of homes selling over list price.
Here's what this tells me. Nobody is panicking. Nobody is slashing prices by 10, 15, 20% to move a house. What we're seeing here is a functional seller's market.
Yep, I agree, Nick. Now, let's talk about how fast homes are selling. Looking at the most recent closed data, Morrisville was bringing up the rear at 28 days. Cary was at 7 days. Apex was at 12 days. Holly Springs was at 8 days. And Fuquay-Varina was at 16 days. These are all very similar to last month and last year. And just for fun, because we're crazy like this, I looked up the median days on market for closings in May of 2019 before the pandemic madness. And guess what? With the exception of
Morrisville,
the days on market are very similar to what they are this year.
You guys, this is great news. No town is sitting at 30, 60, 90 days. That's not a distressed market.
Exactly, Nick. Generally speaking, the market is pretty flat. So, Nick, hit us with the Chapel Hill and Carboro numbers.
Okay, so looking at the same May 2026 closing data, Chapel Hill has 2.8 months of supply, and Carboro is at 1.2. Carboro is actually one of the tightest markets in the entire data set, tighter than Cary.
Damn! What about the list to sales price?
Chapel Hill sellers are getting 97.6% of list. Carboro is at 99.4%. Carboro sellers are essentially getting full ask.
Nice. And what percentage of homes sell over asking price in those towns?
Well, in Chapel Hill, 27%, and in Carboro, 33%.
Awesome. How long are homes taking to sell? What are the days on market?
Well, since you have a lot of questions today, Chapel Hill is at 9 days, Carboro is at 6. 6 days. That's Cary level speed.
Yep, those two areas seem really comparable. Thanks, Nick.
Welcome.
Okay, as promised at the top of this episode, let's talk about the fear some people have based on the national news headlines about the market crashing. So let's talk about real estate market crashes. Nick, do you know what causes a real estate market to crash? I mean, like a real crash, like in 2008.
I'm going to go with forced selling.
Ding, 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 ding. We have a winner. Yes, that's exactly it. When a large number of people have to sell their homes, not choose to, but have to, you get a flood of inventory, prices fall, and the cycle feeds on itself. Okay, one trophy down. And Nick, do you know why there was so much forced selling in 08, 09 during the Great Recession?
Subprime mortgages.
Oh my God, you're a genius. Right again. In 08, 09, the reason you had forced selling is because people had mortgages they genuinely could not afford. You may have heard of the term subprime mortgages, which are mortgages that are given to people who are not well qualified. Now, during the run-up to the Great Recession, subprime mortgages were being handed out like candy. Oh, my favorite. Thanks, Nick.
Welcome.
And most of those subprime mortgages came in the form of adjustable rate mortgages.
The theory was that housing prices would continue to increase and borrowers would refinance before the rate adjusted.
When that didn't happen and rates reset, payments became impossible. People were underwater, meaning they owed more than their house was worth.
So they couldn't sell, they couldn't refi, and they couldn't pay.
Exactly. That's forced selling. That's what caused the crash. So when you see a foreclosure headline today, the question you have to ask is this forced selling at scale?
To answer that question, let's look at the actual data.
Good idea. Beginning with foreclosure data, yes, foreclosures are up. In the first quarter of 2026, about 118,000 properties nationally had a foreclosure filing. That's up 26% from a year ago, which is the highest number since 2020. That sounds alarming until you look at the context.
Well, give us some context.
Okay. Following the 2008 housing crash, foreclosure filings peaked at over 2.8 million in a single year. At 118,000 last quarter, that annualizes to just 470,000. That's less than 1/6 of what we saw at the peak of the crisis.
Ooh, good context.
Thank you. We're not seeing a crash signal. We're seeing a return to normal after pandemic-era protections kept the numbers artificially low. Forbearance programs, for example, kept people in their homes even when they were behind on their mortgage payments. Now that those protections have expired, the backlog is working its way through the system.
And don't homeowners have more equity now than they did then?
Yep, that's another huge piece of this puzzle. The average homeowner today is sitting on roughly $200,000 or more in home equity. Back in 2008, many people owed more than their homes were worth. Selling wasn't an option, and foreclosure was often the only way out.
That all makes sense. What else you got?
Well, I've already mentioned that subprime mortgages were a big factor in the increased foreclosures during the Great Recession. But the Dodd-Frank Act passed after the crash specifically to stop that. Banks are now required to verify income, they require higher credit scores, and they hold more conservative underwriting standards. These regulations were designed specifically to prevent what happened in 2008. Think of it this way. The joke was, if you could fog a mirror, you get a loan. No income, employment, or asset verification. These were called no-doc loans. Today, if you've been through the mortgage process, you know banks want you to verify everything. It drives buyers absolutely nuts. But the bright side is borrowers,
I cannot say borrowers.
people who borrow money in the market now are well qualified. They can both make their payments and fog mirrors.
Multitasker.
That's right.
Isn't unemployment another factor in forced selling?
Well, yes, Nicholas, it is. Regardless of the interest rate, if you don't have a job, it can be really tough to make your mortgage payment.
Preach.
These trains, my God.
Is happening today.
But the trains are driving us nuts. But the Triangle has a favorable employment story that differs from many other areas of the country. The Raleigh unemployment rate is around 3%, and normal unemployment, or what economists consider a healthy, functioning economy, is generally considered to be around 4 or 5%. And currently the national average is around 4.3%. So here in the Triangle, we're below the national average and the normal unemployment rate. To put that into context, Nick, at the worst of the financial crisis, can you guess what the national unemployment rate was?
10%.
Oh my God, it's like you're reading from a script.
I would like to take this moment, though, to thank all of you.
Okay. Pipe down. Yep, unemployment hit 10% during that time frame, and we're nowhere near that.
But the bigger story isn't just the number, it's who employs people here.
Absolutely. Research Triangle Park and the surrounding Raleigh, Durham, Cary, Chapel Hill area are driven by a strong mix of employers, especially in technology, life sciences, biotech, pharmaceuticals, healthcare. Are you counting? Higher education, finance, and research. Major names in and around RTP include companies like IBM, are you counting again? Cisco, Lenovo, Apple, IQVIA, Duke, and UNC Health Systems, along with a growing number of startups and research-based companies. The jobs that drive our real estate market are high-paying and growing.
Okay, so what does all this mean for buyers and sellers in the Triangle market?
Great question. Here's the deal. The market is fairly flat. It's not crashing. It's not booming. It's doing what a healthy, mature market does when it's trying to find equilibrium after a few wild years.
And although foreclosures may be rising nationally, they're just really returning to normal, not signaling a crisis. And the Triangle specifically has a job base that insulates us from a lot of the national, forgive me, volatility?
Volatility. Took us a few times to get that word, but we nailed it. Volatility. So when you hear scary national headlines, filter them through this question. Does that apply to a market where the unemployment rate is low, home equity is high, and the main employers are pharmaceutical companies, tech firms, and major research university systems?
If you're a buyer sitting on the sidelines waiting for the crash, the data does not support that bet.
Nope. And if you're a seller wondering if you should wait for a better market, this is a good market. You're just not going to get 2021 prices, but you know what? Nobody is.
And what should our viewers do if they have specific questions about what this means for their personal situation?
I'm so glad you asked, Nick. They should book a free consultation on our website and let's chat about it. The link to do that is in the description below.
Before we go, remember to like and subscribe so you can keep your finger on the pulse of real estate in the Triangle.
That's all we got for this week. Bye.